If you run a business and you've recently crossed that $80,000 a year mark in profit, here are 5 financial moves that you should consider. These moves are usually the first place I look with my clients for easy wins, and they can usually save you several $1,000s a year or give you returns for years to come, if not both. So first, what would you do with an extra $5,000 in your pocket this year? Well, doing this first step might do just that. And this is cleaning up your books. Maybe you've been DIYing it, or maybe you just haven't done a great job at keeping detailed financial records. In either case, now is a great time to look into improving that part of your admin. Some businesses do fine bookkeeping in-house, especially with how much software there is these days to do that. But it also might be a task you want to outsource, especially if it's not your forte. Both are perfectly valid as long as the task is getting done and getting done correctly. If you miss this, you could be handing an extra 5 or 10% of your profits over to the IRS when that's not necessary. I know some business owners that have outsourced it and other business owners that make plenty of money but still choose to do it themselves. Next is to evaluate switching to an S corporation. If you file as an LLC with no special tax treatment, it might be time to consider switching to an S corporation. What does this mean? Well, it means that come tax time, your company is treated a little differently. Up until this point, every dollar of profit that your business has made is passed directly to you, and you pay self-employment tax on all of it. Self-employment tax includes things like Medicare and Social Security. However, when you file as an S corporation, things change. First of all, you pay yourself a reasonable salary based on what you do for your business. The IRS has guidelines in order to know what's reasonable, and this would be a good place to consult with a CPA. We'll talk about that later. Any profit that your business makes over the reasonable salary that it pays you, you take as a distribution. But the real advantage here is that you only pay FICA taxes, which is Social Security and Medicare, on that salary. You don't pay FICA taxes on the distributions that you take. You only pay income taxes. This means that your overall tax bill might be significantly reduced at this point in your business. Now, there are a few drawbacks. First of all, now you actually have to start paying for payroll if you weren't already. Payroll providers usually have their own costs, and this is going to introduce some tax complexities. So it's a good idea to have a CPA or EA in order to help you, both of which cost money. But if your business has grown to this point and you're starting to make decent money, you're going to have more tax savings more likely than not, even if you're paying fees for a CPA and for someone to process payroll. And next is to start contributing to retirement accounts. Up until this point, you've probably put most of your money back into running your business. But if you're actually taking home $80,000 a year in profit, you should have some money left over to save. If you don't, then it might be time to take a good hard look at your personal budget. While yes, retirement accounts are a great place to save and invest for years down the road, they're also a really big place to take advantage of the deductions that you get from a tax standpoint. When you have higher earning years, you can take extra money and put it into a SEP IRA or a solo 401k and defer the taxes to when you would actually live off them in retirement. Years down the road in retirement, your tax bracket might actually be lower than it is now, especially if you have years where you're earning a decent amount of money. But even if you're not earning a lot of money and still want to save, you can still contribute to a Roth account where that money can grow tax-free, even though you're paying the taxes up front. So if you're going to be in the same tax bracket or a higher tax bracket in retirement than you are this year, then it might make sense to put that money into a Roth account instead. I've made a different video explaining the different kinds of retirement accounts that small business owners have access to, and I'll put that link in the description. At this point, you may have noticed that I've talked a lot about taxes. And that's because once you cross this $80,000 a year threshold, taxes become a really big pain point. It's going to be the biggest expense of your whole life, which is why it might seem like every business owner is looking for every which way to cut their tax bill. And it would also make sense to have some money set aside for quarterly payments. Even outside of specifically tax payments, you should have some money in cash reserves for your business. There are 2 mistakes that you can make with this though. First is not having enough cash, and second is having too much cash. The first one might seem obvious. Yes, if you don't have enough cash and something comes along that you have to pay for, you're going to have to rely on credit or some other creative means in order to pay for it. But why is having too much cash an issue? Because in the long run, cash actually has a negative real rate of return. Cash reserves don't usually keep up with inflation, and so what happens is that cash loses value over time as inflation increases. It's a very unproductive place for money to be, which is why there's also long-term opportunity cost with having a lot of cash. So figure out how much cash you actually need, which is going to vary depending on the kind of of business you have, but then have a plan for the excess cash that goes over that amount. That could be upgrading certain aspects of your lifestyle, or it could be looking at other investments outside of your one business. And finally, you need to build a professional team. More likely than not, your business is only going to grow from here. And small mistakes that may not have been the end of the world early on are going to start costing you a lot more money and time. There are 3 people that should make up your professional team. The first is a CPA or EA. This is going to be your tax advisor. Now, the reason that having that CPA or EA designation is important is because if you get audited by the IRS, one of those 2 can legally represent you to the IRS. People who don't have those designations and are just tax preparers can't actually represent you in the case of an audit. But this part of your team is going to help you year in and year out with tax preparation, tax filing, and helping you make sure that you know what deductions you can take as a part of your business. The next person is going to be an attorney. While you may not have as many touch points with this kind of person, hopefully, it is still good to have a person like this in your corner to help you in case something goes wrong. In case you haven't figured it out already, the small business world can get wacky and weird very, very quickly. Having an attorney that can help you with things like that and with other things that might come up along the way is a valuable asset to have. Finally is a financial planner. This is usually your big picture person who's going to help all the financial pieces of your life come together. Taxes, investments, estate planning, personal cash flow, all of those things would fall under this person's domain. Good ones are going to figure out what kind of things you want to accomplish, big and small, and what kind of things are important to you, and help you build financial systems in order to accomplish those goals. And if you're looking for someone to fill that role, you can visit the link in the description. While there are many other financial moves to consider when you cross this threshold, this is a good place to start to continue to set yourself up for success. And if you want to find out what money mistakes business owners usually make with their money, you can watch this video here.